Remember March 2020? It felt like the world stopped. News channels were a constant scroll of rising numbers, empty streets, and unprecedented boos. For anyone watching the stock market, it felt like a free fall. The Dow Jones, the S&P 500, major indices plummeted at a speed we hadn't seen in decades. In just a few weeks, global markets erased trillions of dollars in value. It was sharp, it was brutal, and it left everyone asking the same question. How long will this last? This wasn't just a blip on a chart, it was a crisis of confidence. The pandemic brought the global economy to a screeching halt. Airlines were grounded, restaurants were closed, and supply chains were completely broken. The VIX, often called the fear index, skyrocketed to levels higher than during the 2008 financial crisis. Investors, big and small, were panicking. They were selling everything, desperately trying to convert their assets into cash. The only thing that felt safe in a world of complete uncertainty. The prevailing logic was simple. If businesses can't operate, how can their stocks be worth anything? The speed of the decline was dizzying, and it felt like we were staring into the abyss of a new Great Depression. But then something extraordinary happened. Just as quickly as the market crashed, it started to climb back. By late spring, we were seeing green days again. By summer, many indices had already recovered a significant portion of their losses, and by the end of the year, believe it or not, the market was hitting new all-time highs. It was the shortest bear market in history, lasting just 33 days. How on earth did we go from a historic crash to a record-breaking bull run in the middle of a global pandemic? The answer wasn't a miracle. It was a massive, coordinated, and unprecedented response from governments and central banks around the world. Think of the economy as a car that suddenly ran out of gas. Central banks, like the Federal Reserve in the US, acted as the emergency fuel truck. Their first move was to slash interest rates to near zero. This makes it cheaper for businesses and individuals to borrow money, encouraging spending and investment instead of hoarding cash. It's like lowering the cost of gas to get drivers back on the road. They also restarted a program called quantitative easing, or QE. It sounds complex, but just think of it as the central bank buying up massive amounts of government bonds and other assets. This injects a tidal wave of cash directly into the financial system, ensuring that banks keep lending and the financial plumbing doesn't get clogged. But the central bank's actions were only one side of the coin. The other, arguably more direct side was the fiscal stimulus from governments. In the United States, Congress passed the CARES Act, a historic multi-trillion-dollar relief package. This wasn't just money for Wall Street, it was money for Main Street. You probably remember the stimulus checks that arrived in bank accounts. This was direct aid to households to help them pay bills and buy groceries. For businesses, there was the Paycheck Protection Program, or PPP. These were forgivable loans designed to help small businesses keep their employees on the payroll, even if their doors were closed. The goal was to build a bridge over the economic chasm created by the lockdowns, ensuring that people and businesses could survive until the economy reopened. This two-pronged attack of monetary and fiscal stimulus created a powerful tailwind for the stock market. With interest rates at zero, traditional safe havens like savings accounts and bonds offered almost no return. This pushed investors from large institutions to everyday people towards the stock market in search of growth. The famous acronym TINA, meaning there is no alternative, became the mantra of 2020. If you wanted your money to grow, the stock market felt like the only game in town. Furthermore, all that stimulus money had to go somewhere. While many families used it for necessities, a portion of it found its way into the stock market. We saw a massive surge in retail investing. People stuck at home with extra cash from stimulus and fewer things to spend it on opened brokerage accounts on platforms like Robinhood. This influx of new enthusiastic investors, often focused on high-growth tech stocks, added even more fuel to the market's fire. They saw the dip as a once-in-a-generation buying opportunity. The nature of the pandemic also created clear winners and losers in the market. While travel, hospitality, and energy stocks suffered, a new class of stay-at-home stocks thrived. Companies that enabled remote work, e-commerce, streaming, and home fitness saw their valuations soar. Think of Zoom, Amazon, Netflix, and Peloton. Their business models were perfectly suited for a world in lockdown. This created a K-shaped recovery where different sectors of the economy recovered at drastically different rates. Investors piled into these tech giants, believing they were not just surviving the pandemic, but were fundamentally reshaping our future. The rapid rise of these mega-cap tech stocks pulled the entire market up with them. So, when you look back at the whiplash of 2020, it's a powerful lesson in how modern markets work. It showed us that a catastrophic crash doesn't necessarily mean a long, painful recovery. The speed and scale of the government and central bank response completely changed the old playbook. They threw an unprecedented amount of money at the problem, and for the stock market, it worked. The rapid V-shaped recovery was not a sign that the real economy was finite, wasn't it? It was a direct result of policy decisions that flooded the system with liquidity and left investors with few alternatives to stocks. Of course, this story isn't without its consequences. That massive injection of money is a key reason why we're dealing with high inflation today. But that's a story for another video. The key takeaway from the 2020 crash and recovery is the sheer power of policy intervention. It demonstrates that in times of crisis, governments and central banks have powerful tools at their disposal, and their willingness to use them can turn a potential decade-long depression into the shortest bear market in history. It was a wild ride, and one that will be studied by economists and investors for generations to come. Thank you so much for watching. I hope this breakdown helped you understand the incredible market dynamics of 2020 a little better. If you found this video insightful, please give it a thumbs up and consider subscribing to the channel for more deep dives into the world of finance. Don't forget to hit that notification bell so you won't miss our next video. See you next time.